Rana Gupta, a Senior Portfolio Manager, India Equity Specialist at Manulife Investment. Rana, good to have you with us here. Thanks very much. I just want to start by asking you, this new listing today, Grow. I mean, I think it's a business which most people understand because most of our audiences would use some form of broking, if not Grow. So they're familiar with how the business works. And of course, I mean, capital markets as a theme is also has been on everyone's list as a secular kind of theme for many years. How would you think about a business like this, Rana, in terms of the valuations you would ask that you would give? So at the price that it came to the market cap it was asking for on F5 27 basis, I think Grow comes to you at about 25, 26 times earnings.
Sure, thanks for having me. The way we look at the digital businesses, particularly the ones which has a very large TAM, like financial services, and if the company is vertically integrated on the back end and can offer a plethora of financial services, not just broking, they stand the opportunity to gain from cross-selling to the customers different kind of financial services, wealth management and commodity trading and whatnot, at a very low customer acquisition costs. So if one were to take a slightly longer term view, like 2 to 3 year view on these companies, I think their profits growth going to be quite strong and their valuations will perhaps be a little premium to the traditional, let's say, offline brokers and to also the premium to the brokers that are online and offline. Just a data point, we look at the largest listed online broker at the moment and look at the one that is listing today. Their top line is broadly the same, but the bottom line, there's a huge difference. I think that is the power of platform that one has to recognize.
Yeah, and we'll see how Grow does in its listed market journey, and we'll have the rates in just a bit from now. Rana, good to have you join in. What have you made of the Q2 earnings season? I mean, we started the year with expectations of at least 12-13% earnings growth. At the end of Q2, you think we're on track with those assumptions?
So we started the Q2 earning, as far as we are concerned, we started with about 10% earning growth for the year. And looks like, if I now factor in Q2, looks like pretty much we're on the track to deliver 10%. Having said that, I have to say that the earnings surprises has come from some of the financials, where the earnings were very good. Auto results were expected to be strong, but they have become even stronger. And from our side, what we feel is that domestic infrastructure companies, and by infrastructure, we define something like telecom, hospitals, hospitals, and all those things, they have also come quite good for us. So I think for the full year, we are quite confident that 10% will be delivered. The attention of shifts to FY27 and 28, where the projections is about 15%, whether that comes through or not. If in case it comes and our conviction on that is high, and we can talk about it why, then it will point inflection in earnings. If you zoom out and if you see FY25 and FY26, earning growth declined from 15-17% to more like 8-10%. Then if these earning estimates were to come through, it will inflect back to again from 8-10% to 15% in 27 and 28, which is something we are quite hopeful about.
Hi, Rana. Good to see you. Ben, I wanted to ask you about the space, the quick commerce space. There was a lot of enthusiasm, and these stocks did very, very well. Now, silently, these companies have gone ahead and they've given actually quite a large correction. If you look at Eternal, it's closer to 300 rather than 370 that we saw earlier, this month. Even Swiggy is way off the peaks that we have seen. Any view on this theme? They're getting money. When they go to raise money, they're getting money. Swiggy, for example, they're going to be raising 8-10,000 crores or thereabouts, in spite of having good amount of cash. What is your view? The runway seems to be big. There's a fear that intense competition comes in there. And when will profitability come? Your take.
Sure. First of all, let me just unequivocally say that we like the digital space.
Okay.
Because the digital space, this kind of connects the large customers with a good backend supply. But because the company is digital, that is not a guarantee to success. After we establish that we like digital companies, there are many key result areas that we need to monitor. For example, for quick commerce, the store productivity, the profitability of the older stores, the order value, how the company is pushing technology to the edge to tick those matrices up. On that count, the largest quick commerce company rates actually quite well. And this kind of fear that comes to the market that just because someone is putting $1 billion, they will be able to compete with their profits. I think they may have some merit, and that can affect 1 to 2 quarters. But for medium to longer term investors like us, it's we would like to see this as an opportunity.
By the way, we should tell our viewers that Tata Motors' CV business is going to be listing as a separate entity. Demerger is complete, and now when you have the option of playing the PV side or the CV side in different entities. And on that, Rana, where are you? Let's talk autos with the specific focus on CVs first. Over the last at least couple of months, numbers have started looking a little better. In fact, I think we're expecting Ashok Leyland to come out with a very good set of numbers again for the second quarter. So how do you look at a large entity like Tata Motors? And I mean, without getting into it's not a buy or sell question, but generally this demerged structure, would it perhaps offer more choice and unlock more value?
Again, we would not be able to talk on stock specific, but in this case, the merger that has happened, the passenger vehicle business still carries JLR. The Range Rover and all these things. I think for us sitting here in Singapore or for people sitting in India, it's very difficult to understand how a luxury car platform is going to perform. Especially directionally, when they were at a lower utilization, one could have taken the direction call, but now that offer at near utilization, incremental margins, at least we find it very difficult to call. So that being said, I think on the auto side, the commercial vehicle side was commercial vehicle was the other question. Commercial vehicle will typically depend on the industrial activity and the capex that we see. I think capex will continue, but we are not seeing that incremental delta will come through capex. So perhaps CV sales have bottomed out and they will, grow at a pretty, let's say a higher single digit phase. But that's, I think, not very exciting as far as we are concerned. In the auto space, what we continue to like is the utility vehicle space, because the premium consumption, I think, was strong already, and with this tax cuts that has come in, I think it gets another boost. Although I understand that small cars and entry-level two-wheelers have done well for September and probably continue till December, our medium to longer-term view is the segments that were doing well, which are like bigger bikes and utility vehicles, will continue to remain stronger for longer. So that's the space that we like in the auto.
We leave it there. Thank you very much for joining us with that perspective. Always helpful, Rana, and good speaking.